Hello, this is Megan Horneman, the Chief Investment Officer with Verdence Capital Advisors. We're coming to you today to give you a recap of the third quarter of 2023, and we also want to offer our outlook for the remainder of this year. There's been a lot of changes and a lot of things happening over the past few months, so we got a lot to talk about, and we're going to dig right into it. The major theme in the third quarter was really the realization that the Federal Reserve and many global central banks will have to keep their interest rates higher for longer. For so long, they've been reiterating this over and over and over again, and we have not seen long-term interest rates rise. But what you can see in this chart is in the third quarter, the 10-year US Treasury yield rose to the highest level since 2007. And it didn't stop just in the U.S. This was a globally coordinated rise in interest rates. The German 10-year bond rose to the highest level since 2011. The UK 10-year rose to the highest level since 2008. And even the Japanese 10-year, which has been basically at zero and been controlled by the Japanese government for many, many years, rose to the highest level since 2013. So what did this massive rise in interest rates do to the equity markets and the other asset classes? Let's take a look at this chart. You can see that what we saw was a valuation correction across equities. After the MSCI All Country World was off to one of its best starts that we've seen in the past 4 years, we saw a pretty big decline across all the global equity markets. Within the U.S., it was concentrated in growth and the small and mid-cap sectors. Internationally, it was also a developed market story. And then when you look at the bond market, you can see the damage that was done to long-term interest rates. The 30-year bond was down more than 10% in just a single quarter. The only area of the fixed income market that was able to post modest gains was those leveraged loans and floating rate notes, very short duration bonds. When you look at commodities, it was still a supply and demand imbalance story. Energy saw a massive jump. This was before the events that occurred in the Middle East, and that's because we still have supply constraints given that Saudi Arabia has cut production.